You put out a tweet the other day, the whole crypto market besides Bitcoin right now is unregistered securities. What should happen? Should, some get fined, or should they all go to zero and start new? What's the solution there?
I don't know what the solution is. I think that the industry would benefit if the SEC and the CFTC put out clear guidance as to how you qualify as a digital commodity. For example, if you could submit, if you want to go public, you actually submit a registration statement to the SEC and you negotiate it with them. And over the course of 3 months or 6 months, when they grant you, when they approve the registration statement, you can go active, and then you're a publicly traded company. So there is a process by which you can take a company public as a public equity. If you don't get that approval, then you can't go public. You can't sell shares to the general public. So right now, the question is, if you had some crypto, the only crypto that's been deemed as a commodity is Bitcoin. That's the only one that I think is certain. I mean, everything else is a question. And the chair of the SEC said that on television a few days ago, right? So the question then becomes, okay, I think that my crypto is a commodity. How do I get it certified? Okay, there's no clear process. So if there was a process by which I could submit it to the CFTC or the SEC and get them to certify that it is not a security, that would be a step forward. I think the other step forward would be a process by which I could submit a stable coin to get it certified as a stable coin. Like there's a way you can get registered as an ETF right now with the SEC. Right? They deny or they grant. They've granted some ETFs. They've denied some ETFs, but there's a process. There's a process by which you can sell mutual funds and other investment funds to the general public. They can grant, but they can deny. So I don't see the process by which I can spin up a stable coin. And as you look at it, right, there's stable coins like Circle and Paxos, and they're registered entities in the United States, and they claim to be 100% backed by cash and cash equivalents. So that's one type of stable coin, but the SEC is not certifying them. The CFTC is not certifying them. There's no national certification. I think they've got money. They've got licenses from states. So there's no FDIC registration. There's no SEC, CFTC. I think that's frustration. Then you've got Tether, right, which is sitting in the middle, right? It's more opaque, popular but opaque, and the problem is because it's opaque, it's getting attacked. People are not so much. If people think they can wreck you, they'll attack you, right? I mean, it's kind of sad, like I'm not a big fan of hedge funds and short sellers myself, but they will attack. And so they shorted UST and that worked for them. And so now they'll short Tether. They're not shorting Circle and Paxos because they perceive that they're not wreckable, right? Then you have UST, which some people thought was a stable coin. I mean, you could have called it a stable coin. They would add up, the market cap of stable coins. They added up Circle and Tether and UST. But when UST had $18 billion worth of value, the question is how much collateral was backing it, right? At one point, UST plus Luna was about a $50 billion ecosystem. And, they had $1 billion, maybe $2 billion. Did they have $3 billion in collateral? Somewhere between $1 and $3 billion in collateral against $50 billion of a float and $18 billion of a stable coin. Now, issuing $18 billion worth of a stable coin is like borrowing $18 billion from counterparties. So if you borrowed $18 billion from counterparties and you had $1 billion in collateral, you're levered up 18 to 1. Okay. On the other hand, if you borrowed it at 50% loan to value, then that means you have 36 billion in collateral. So you see the difference between having 36 billion in collateral, which is, by the way, 50% loan to value is risky. 25% loan to value, probably less risky for a volatile market. So in order to issue 18 billion in stablecoin and use Bitcoin as collateral, then the right mix would be, I have $72 billion worth of Bitcoin, and I issued $18 billion worth of UST. Okay, and that's over collateralized, but still risky. So it's pretty clear UST was never a stable coin. It was a security. The point of the regulators when they say these, these cryptos need disclosure is, if you'd known that you were buying a token that had $1 billion in equity and 20 billion in debt, and that a 5% move would wipe you out, you wouldn't have treated it like cash or cash equivalent, right? You wouldn't have said, oh, this is like a bank account that yields 20% interest. You would have said something different. You would have said, this is extremely risky. This is like a 20x margin trade. And if Bitcoin trades down 6%, I'm going to lose my life savings. So there's no way right now to certify, to get like a national certification for a stable coin. If there was, it would drive a process, and people in the space would go through the certification process to get that. There's no way to create a certified crypto bank right now, right? The reason you had Celsius and Voyager and BlockFi as kind of uncertified, unregistered bank, is because the regulators they were loose with regard to cracking down, but they also didn't give a path to certification. Caitlin Long, has created a crypto bank, and she's been trying to get an FDIC license for 18 months. She can't get it. And there's no path. There's no obvious path to get the right license. But you can imagine if I was running an ETF and I said, I'm running a high-tech ETF and I'm going to buy a mixture of Facebook, Apple, and Amazon and trade it, and you were going to buy my ETF. Well, I would then post on a routine basis, like every day, or whenever I change my portfolio, I post what I own in the ETF. That's complete transparency. And if we can do that with an ETF, the question is, why can't we do it with another crypto? Like, why wouldn't you just say, okay, Tether, if you want to be certified, you just have to post everything online via this form, an 8K form. When MicroStrategy, when we buy Bitcoin, we file an 8K. It's an SEC filing. And if you go read it, right, there are very, very talented lawyers that very carefully write those 8Ks, and then they file them with the SEC, and they're online and they're legal documents. And the management team is legally liable for a lie, right? We're legally liable. The CFO, the CEO, probably the general counsel. And so you end up with adult supervision. And you end up with, since everybody's liable, the accountants are liable, they're worrying about it. The outside law firm is paying attention. There's an army of lawyers, there's an army of accountants. And because you do that, well, everybody knows where you stand, and then they can make a decision that's intelligent. We're lacking that in the crypto space. And there's no way for me to issue a token that's a security. There's no way for me to issue a public NFT token that's regulated. There's no way for me to get a commodity created that's regulated. Also, there's this issue of exchanges, right? Like either a DeFi exchange or a CeFi exchange. They're deemed as being unregulated. The reason that this SEC keeps denying the spot ETF of Bitcoin is they claim that all the crypto exchanges are unregulated, and there's no surveillance agreements and there's no transparency. But what they're really saying is they don't trust the exchanges. They think they trade against their own customers, right? So if you're buying a token, like let's say you were buying some random coin on an offshore exchange and you had a big order in. If that exchange actually was operating a hedge fund and they got your order and then they front run you and they bought that token, drove up the price, and then sold it to you, you'd be pretty irked, right? Well, so when the regulators are concerned about that, their view is there's just too many conflicts of interest, right? Like you could issue a token, own a bunch of the token, and then you could list the token on your exchange. The price would trade up, then you could sell it, and then you could not tell anybody you did it. That's all totally illegal with a security, right? You couldn't do it. It's pretty obvious to everybody that is unethical. It is illegal. And there would be like 100 people that would tell you, no, you cannot do that in the traditional economy. In the crypto economy, it's not even clear that they know that it's unethical and illegal, right? It's like sometimes people they just think that's just being creative. And so in this particular case, you've got a Wild West, and what needs to happen is it needs to grow up. Now, we need adult supervision. Now, let me just grant one more thing in favor of the cryptos, which is there's a tension between the 20th century and the 21st century. The 20th century is NASDAQ. You start trading at 9:30 in the morning, you end at 4 in the afternoon. You can't trade on the weekends, right? You can't take personal custody. That's how MicroStrategy stock trades. MSTR started trading in 1998. And there has been no material improvement in the way that stock works on the NASDAQ in 24 years. Okay, so that seems kind of antiquated. And the crypto world is why can't I take custody? Why aren't there 500 exchanges instead of one NASDAQ? Or why can't I trade 24/7, 365? Why can't I do things faster? So the crypto world wants to go fast, and it wants sexy stuff, and it wants to do it in the palm of your hand, and it wants to do it everywhere in the world. And it wants to do it on a holiday, on Labor Day. Okay, so those are all admirable, right? That's 21st century technology. The 20th century technology as well, we've got the compliance down, and we've worked through the ethics and the conflicts of interest. And it's pretty clear to me, for example, that I have an obligation to tell all my shareholders any material thing that I do at my company that might impact their shares, right? That's pretty obvious to me. So we've got adult supervision in the 20th century world, but it's expensive and it's slow. And it's not functional. The functionality, there's low functionality, it's very expensive, and it's slow, right? In the 21st century, you've got crypto, which is very functional, very fast, but they haven't worked out the regulations and the protections for consumers. And so, it's kind of hard to defend it if you watch $50 billion get torched and go to zero in a matter of 2 weeks. We can see why that's not so good. But what the world wants, the way this should end, what you'd like to see happen is you'd like to see the regulators embrace the good that's come out of the crypto world while extending some investor protections that are common sense, like thou shalt not lie, cheat, and steal. These are not like from 1933 SEC Act. They're not 1940. These are like 4,000-year-old rules, right? Hammurabi's code. They're in the Bible, right? They go back to ancient times. The Greeks, the Romans, everybody had this idea, thou shalt not lie, cheat, and steal. So we need somehow to introduce those common sense guidelines into a modern technology framework. And right now, for better or for worse, it's the United States regulators, the SEC, the CFTC, the OCC. They have the control of this, and the rest of the world's going to follow them, right? And probably going to adopt their broad brush guidelines once they figure out what they want to do. And the industry is kind of in betwixt and in between. We're out of the first decade, which is a lot of innovation, a lot of creativity, a lot of, Mark Zuckerberg used to have on the wall of Facebook's headquarters before they went public. It's like, go fast and break things. Okay. That was the Facebook motto, go fast and break things. After they got public and after they became a billion user network and they had the power to change the course of democracies, I think they got rid of that motto, right? That, at some point you can't go fast and break things anymore. So I think the crypto world is moving from its first decade, which is go fast and break things, to the next decade, which is let's try to keep, you know, the good that comes from the technology while we introduce it into the public policy framework that allows it to scale to the next order of magnitude. And if you're wondering what do the regulators think is good about crypto, this is not a secret. They've said it out loud. They think Bitcoin is good. They think that proof of work, such that you create a digital commodity using energy and no issuer, is a good thing. It's an innovation. It's a brilliancy. Well, what Satoshi did, the creation of digital commodity in cyberspace, or digital energy, or digital property, if you will, or digital money, using energy and SHA-256 or some hashing algorithm, that's a brilliancy. So there's a place for digital commodities. The second thing they like is digital currency, like a stable coin. The world wants trillions of dollars of US dollars and probably digital euros and digital yen to move at the speed of light on mobile phones and on websites. That's an innovation. And we haven't quite got it right, right? We've got UST, which is a defective one. We've got Tether, which is successful, but opaque. And then you've got, you know, Circle, you know, packs that are struggling, and there's no FDIC approved bank that's issued a stable coin yet. So that's a new thing we're working on. And then I think they appreciate 24/7, 365 trading. Right, that's an innovation, which is clearly an improvement over the 9:30 to 4 in the afternoon, 5 days a week. The rest of the world doesn't necessarily take American holidays off, and Sunday's not a holiday in the Middle East, right? And so and shutting down the economy of China because you want to declare a holiday in California isn't the way to run a global ecosystem. So global access, that's another plus. And then the final thing is just the idea of crypto tokens, right? Cryptography, zero proof, and the ability to do things instantly in 100 milliseconds, right? That's an innovation. Right now, a lot of the world still approves wire transfers by talking on the phone, right? And that is about 10,000 times more expensive than doing it by signing with a private key. So all of those crypto capabilities, those are an innovation. I think all of those things together, plus just speed, like being able to spin up a token, you know, whether it's a Tom Brady coin or whatever coin, being able to spin it up is an innovation. Now we know what the innovations are. And the question is, how do you merge that with regulation? And we'll see, right? We're waiting on that.